Manish Gunwani joins us. Let's take the conversation forward. Manish, good morning. Thank you for joining us. Manish, it's been so far so good. Looking at where we were versus where we are right now, you can't complain about the levels of the equity market. But will these levels sustain, or are we in for a pause, or are we in for a retreat now as we roll from the first half of the year to the second half of this year?
So, Nikhil, I think we are probably at a point where a lot of near-term positives, to be honest, are priced in. So in the near term, maybe our upside can't be very high because, as we've discussed, basically your earnings 12 to 18 months is already quite well discounted. But again, we are also at a point where last 6-7 years, due to various reasons, macro, micro, a lot of companies have gone through down cycles. The overall earnings of corporate India last 6-7 years have grown at maybe 4-5%, which is much less than nominal GDP. So if we are talking about a 3-4 year earning upcycle, which could happen, nothing is guaranteed, but it could happen. Then I think equities as an asset class will continue to do well after what I think would be a phase of consolidation over the next couple of quarters. The good part is that I think a lot of people look at the domestic economy and are a bit surprised at market strength. I think we have to remember that a lot of our market is about what is happening in specific industries, and point number two, what is happening globally. I think globally the economic recovery is quite strong. Also in a lot of bottom-up sectors like pharma and telecom, positive things are happening. So overall, I agree that maybe on a 2-3 year perspective also, especially in the large cap space, maybe the returns can't be super normal. But I also think that the broader market presents much richer opportunity from a 2-3 year perspective.
Manish, for broader market to come back, companies have to do well. Mid and small cap companies have to do well. The nature of the economy is such that within the private banking space, forget PSU versus private, within the private banking space, there is a consolidation. In the IT space, there is consolidation. In the retail space, there is consolidation. In the media industry, there is consolidation. In the mutual fund industry, the financial services, there is consolidation. So if the economy is migrating towards large becoming big and big becoming mega, then what sense does it make for anybody to go outside the comfort zone of Nifty 50 or large cap stocks?
Because that's an interesting point. We also are seeing obviously a lot of consolidation due to various reasons, ranging from compliance to lack of funding for the smaller pieces. But I think there are 2-3 points here. One is that when we say mid and small cap, I think there are enough mid and small cap companies which are leaders within their own industries. So, for example, you talked about auto. Now, if you look at spaces like tires or commercial vehicles within that sector, most of the plays would be mid and small cap, and they have phenomenal operating leverage given that the cycle is fully kind of broken for last 18 months. Now, obviously, if the cycle recovers, a lot of these stocks can do well. So, across whether you see IT, interestingly, you mentioned, we're seeing a lot of mid-cap companies grow faster than the large-cap companies and trading at a discount. Similarly, across real estate, if you see, most of the stocks are mid-caps. A lot of cement mid-caps, they may not be as efficient as the large-caps, but they're trading at a valuation gap which is quite strong. So, my point is either you look at mid and small caps, which are winners, which are leaders, or where the valuation gap, like if you saw the FMCG space 3 or 4 months back, there were a lot of second or third tier FMCG stocks which were trading at a huge discount to the leaders. And we've seen over the last 3-4 months, these FMCG stocks, which are typically the low beta sector. But you've seen these FMCG stocks do 50, 70, 100% return in 3-4 months. So those kind of opportunities, I think, are there across the broader market. And the third segment is, if you see, we have to acknowledge that while valuations in the technology or the digital platform space are very expensive, quite likely they will become a bigger part of this market. And there are a lot of mid and small cap space uh, plays which are of that type, which are catering directly or indirectly to this digitalization or tech platform team. So I think the broader market is quite rich at this point, Nikunj.
Manish, hi there. Good morning. Wanted to get in your take as to, what the outlook is when it comes to the general insurance space as well as retailing. As long-term themes, do you think that these are viable opportunities, and what would you look at in terms of company or business-specific metrics?
General insurance, I think, is a very, very interesting space. Personally, I find it very attractive, given that if you were to benchmark India's industry size today to US or China, across different industries, this is probably one of the most underpenetrated industries at this point. In segments like health and fire, India is very, very nascent. And obviously, as GDP grows, this is the kind of industry where the expenditure is higher than nominal GDP for next 10, 20 years. Retailing as well. Now, retailing, I think offline retailing is a beaten up space globally, especially in US, because they obviously built out retailing 30, 40 years back, and they're getting hit by online. But just like in spaces like two-wheelers where the developed markets don't have too much market cap, but we do. I do think that offline retailing will have a positive cycle. It's obviously gone through a very tough time with COVID. So there will be winners in offline retailing as well. I think while digital and technology will obviously grow very fast in India, even in South Korea, which is seen as one of the leading internet and telecom kind of markets. If I remember the data, basically only about 20-25% of retailing is online. So there will be, and maybe there will be a lot of convergence. So if you see the stock prices of Walmart or Target, they've done very well because they've kind of adopted to the online model and kind of imbibe that into their overall model, becoming omni-channel in a sense. So I think what we were discussing just a few minutes back, when you look at mid-cap, large-cap space, whatever, I think one of the key points you have to see is whether the company is able to adopt to the digital system. So it's not, India will never, I think, have a very big weight on pure digital technology firms like a Google or Apple, because we obviously don't have the IPR. But I also think that in a lot of industries like private banking to broking to retailing, the differentiator for companies which do well, one of the big differentiators will be whether they're able to imbibe this digital platform thinking into their DNA. And it's a lot about DNA because we've seen that even very well-managed large groups have been caught on the wrong foot by nimble startups. So I think as part of the research process, we have to figure out whether a lot of these traditional business models also, which are the winners which can use this digital and technology wave to get into the next orbit.
All right, and Manish, where within some of the richly valued mid caps within the healthcare space are you seeing opportunity? Do you think that after the kind of run up that we've seen, that further re-rating is possible within pharma?
So quickly, if I do look at pharma in probably four buckets. One is the grants and research and manufacturing services bucket. One is the combined domestic pharma with some US presence. That is the second business model. Third is the MNC pharma. And fourth is basically the product-based companies which have invested a lot in R&D, whether it's biosimilars or these one-off opportunities in US. In general, I think where we're seeing relatively more upside is basically the second bucket, which is basically you have a company which has a lot of value coming from the domestic franchise. And well, again, these stocks also have done well. I mean, the whole sector has done well. But I still think that when you look at EV to sales or what a good cycle in generic pricing in US can do for the financials of these companies, we just think that these are the better segment to be in the pharma space. The grants and research outsourcing space does look quite expensive at this point of time. The MNC pharma, we think, is fair valuation. A lot of it because they're kind of substitute for FMCG companies. They have superb cash flow. They have very steady growth, and they have huge terminal value because the pipelines are good, and the domestic pharma market will obviously, hopefully, grow for many decades. But yeah, the valuations have become quite expensive because these stocks have done well. The product companies are obviously very, very bottom up. In general, we are not seeing, again, too much value out there because the stocks have done 50 to 100% over the last 6-8 months. But yeah, so relatively, we think that these stocks, which are a combination of the domestic pharma with US presence, that is where we are seeing some upside.
Manish, what's leading to this underperformance in the telecom incumbents? Now that the AGR uncertainty is done with, what explains the kind of weakness that one has been seeing in Bharti and Idea?
I think the whole point there, and this again, I think is a global theme in telecom, is that whichever companies have remained pure wireless, they've obviously, by definition, become very good cash generating machines, but with very low growth. Now, I think what the market is trying to figure out is what is the kind of cash flow these pure telecom companies can give out, and whether in India the issue is that what we are seeing is typically low growth companies, the valuation drops quite dramatically. So if you see a lot of the PSU companies also where growth is a question mark after 5-10 years, even dividend yields of 7, 8, 10% are available. So I think the challenge for the incumbents is to present a narrative around growth. So probably the market is wanting to see their strategy around the digital services, how they can go into adjacent areas and capture the value add in terms of fintech or capturing the media profit pool, something like that. So we'll have to see whether these incumbents are able to build that narrative. Overall, we think there is value in that space because even if you don't see too much growth, we do think that tariff hikes should happen. It may take, timing is very difficult. But we think that the real appreciation in these stocks over 5-10 years can only come if the growth narrative gets built up.
Sure. Manish, good to have you on the show today. Thanks as always for taking the time out. That's the view on markets by Manish Gunwani. Let's just quickly revisit what the market rates have settled in at what seemed like a mildly positive start.